All right, my name is Chris Campbell. I'm a practicing CPA, and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about, specifically with S corporation owners, Social Security. So as I've been doing this longer and have extended my career, I'm starting to have some clients that are reaching or close to retirement age. So I had a conversation with one of my clients not too long ago, and we're using the strategy of reasonable salary for S corporation owners. If you're not familiar with that, if you go look in my bank of videos, I discussed that before, where we're doing the strategy of reducing your W-2 compensation to reduce the amount that you pay in payroll taxes, also known as Social Security tax. The strategy is we're taking a smaller amount of the compensation as a W-2 income, which is subject to the Social Security tax, and then more of it as distributions, which is not subject to Social Security tax. The flip side of that, though, is, and it just hit me when I was talking to my client the other day, is the client is approaching retirement age, and they wanted to make sure that they were putting enough into the Social Security system, i.e., making sure that they've paid enough Social Security taxes to make sure that they are maxing out Social Security benefit once they retire. So it was an interesting point. So I looked a little bit more into it to see how utilizing the reasonable compensation strategy, but making sure they can max out the Social Security benefit. So from looking more into it, it's actually relatively easy. The threshold isn't really that high to qualify for it, and you can for it over a 10-year span. So you have to earn a certain number of credits for the Social Security system, and in order to qualify for Social Security, you need 40 credits. You can earn up to 4 credits a year, so you can earn everything that you need to qualify for it within 10 years. And the threshold is pretty low if you have W-2 income or self-employment income. So if you file Schedule C, if you have self-employment income of roughly $1,650, you get 1 credit. If you multiply that by 4, if you do the math, what is it, 6,600 bucks a year should get you all the credits that you need for that year, because you can only earn up to 4 a year. So you can't earn a bunch of money in 1 year and earn 0 the next. You can only max out at 4. So you're looking at roughly 66, rounded up to say 7K. If you have 7K in either W-2 or self-employed income running through a Schedule C or on a partnership profits, then you've earned the max for that year. So that bar is relatively low. Now, another thing I looked at was how they actually calculate the benefit that you get. Another thing that you have to consider. Now, I don't know the exact formula. I didn't dig that much into it, but I think they take your 35 highest years of earnings, and there's some sort of indexing or averaging based upon your 35 highest years. Now, those 35 years will only consist of your W-2 or your self-employment income. So those distributions that you were taking or your S Corp income, that will not count within the calculation, nor will any investment income count. We're looking strictly at what they considered earned income. W-2 income, Schedule C, so if you're a single member LLC, those profits, and then partnership profits. So those are the 3 sources of income that will count towards this. So they'll take the 35 highest years, use that as some sort of index, and then they work their magic. Again, I didn't want to get too much into the formula of how they do it. So now there is a maximum that you can get each month. And I think it's roughly $3,800 a month. And it does go up every year, index for inflation or cost of living adjustments. But that's based upon when you raise your hand to start getting Social Security. So the longer you wait, you can start getting it at 62, I believe. But I think you can wait as long as 70 to start. So the longer that you wait, the higher that benefit will be. So it's not 100% tied to your income. So it's not, if you say, hey, I made $1 million for 35 years, max me out. You still might not get maxed out if you take it as soon as you qualify versus waiting later. So the point of the story here is that If you're worried about making sure that you get enough into the system, that really shouldn't be the problem. I would imagine that anybody that's making good money in an S corporation shouldn't have a problem saying that they make at least $10,000 in W-2 salary. So that part shouldn't be the problem, putting in the Social Security. But then that raises the point of just making sure that you're putting more aside for proper planning for retirement investments. So whether that be 401ks, set plan, and those are kind of the two main instruments that you have to look at. If you do that over an extended period of time, that should far outweigh what you're relying on for Social Security. So that's all for now. If you have any more questions about this topic or any other accounting or tax related questions, feel free to reach out. I'm happy to help. That's all for now. I'll talk to you in the next one.